Welcome back to the Deal Mastery Insider. Today, we're going to unpack this industrial supply deal, and I'm going to give you my thoughts about how I would evaluate it. So with that, let's jump in. First things first, here's a couple just snapshots of the deal to give you a high-level sense. I pulled a few of these things from the sim and some of the financials that they provided me. I've anonymized everything, so I've taken out all the information about the company's name or even really what kind of end market it serves. But I think it's still a really cool case study. So a couple things that jumped out at me just off the bat. So we'll look at the sales piece in a minute. Before we jump into the revenue side, I like to look at the balance sheet of the business. And so one thing that jumped out at me is when I look at their balance sheet, they have about $2 million of inventory. When I look at the sim, it says it has about $820K of inventory. And so that's just a disconnect that when I see things like that, I like to ask about them, kind of pop the hood and understand what's driving that. So that's one question I would have. And based on that, it's a pretty meaningful difference. Based on that difference, I've kind of mapped out the collateral base for each of these based on rough discount rates that you'll typically see lenders provide. And you can see that disparity changes the potential borrowing base from about 2.7 million to about 2.1 million. So could be a pretty meaningful impact depending on whether that's real or not. But I would use the conservative assumption that the 800K number they've listed is probably the right number without any further information. So that's the balance sheet side. I like to look at the assets because it gives you a good sense of the financeable assets that you could potentially bring to an asset-based lender or lender in general to look at providing some capital for the transaction. And we'll look at some structures around that in a minute. So now let's break into the P&L. So we've got some interesting data here. One thing of note is if you just look at their P&L, they've got 2023, they've got discretionary earnings of 487K. 22, they've got about 450, and then 21, they've got 360. None of those numbers actually add up to their adjusted net incomes here, right? So that alone would be a big question mark that I would have, is understanding, because they've got add backs here, right? They've got owner salary, benefits, depreciation, interest expense, and other, which I'm assuming is where they put all their other adjustments. And so when I see their summary and then I see their other summary, these numbers do not add up. In fact, they're not right for any years. And even 2021, you can see is a pretty massive difference. It's about a $300,000 difference, about a 100% change in the suggested earnings of the business. So seeing those two disparities again, to me, tells me maybe the broker's a little bit disorganized, or maybe there's something going on here I'm not sure about. But these kinds of red flags are things that I would want to unpack and understand if I was digging into the deal. But given that, let's, with the data we have, form a little bit more of a view or an opinion. So I like to run this valuation matrix or this spread. And what I'll do is I'll typically take the SDE across a couple different cuts or a couple different takes. So I've got 21, 22, 23. I'll get the average, and then I'll get what I'd call the pro forma number, which is basically the estimate that I think it'll be going forward roughly. And I just ballparked 487 for 23. So I said, let's just say 475 is kind of a reasonable start. And then I've got here a chart of SDE multiples by size. So if we assume 500K, midpoint is 2.5. So I've taken the midpoint here without any other info about whether they should be higher or lower. And I've gone by increments that are a little smaller than this range, from 2.5 as a median to low of 2 and a high of 3. And you can see based on the historicals and some of the averages, the operations of the company are worth around, in my estimate, sort of an average of $1.1 million, can be as high as $1.4 million, as low as maybe 800 or 900K, depending on what metric you look at. But broadly, I think $1.1 million is reasonable based on all this data. So when we look at that, the broker's requested price, and then we've got, they have real estate. If you go back to the asset mix, I forgot to mention that. That's about $1.9 million, right? So assuming that real estate value's straightforward, in most cases, real estate's pretty normally valued, so there shouldn't be any big surprises there. But assuming that real estate's worth $1.9 million, business is worth about $1.1 million. In that scenario, the total business is worth $3 million in aggregate with the real estate. So the broker's price on their listing, $4.4 million. Pretty big delta there, right? So on the surface, based on this analysis, I would peg this as being overvalued. That's my initial assessment of this business. And I'll walk you through my thought process why that's the case. So how did the broker get to their number, right? So if we use, I think there's really two things they did. One, The adjusted numbers they had on their sheet, if you remember, they didn't really line up. They had two different sets of adjusted numbers, which is a huge, I think, blunder on their part. But if we use the high side of those numbers and call it an average of 600K of SDE, and we kind of skew these numbers up, as you can see, really 3.5 is the very high side of the valuation for a business like this, but we'll give them credit. So we'll use 3.5 as a midpoint. And if you take that 600K number and 3.5, then you can start to see how they got to sort of an average valuation of around 2.1 million. And so if you take that 2.1 million and then you add back in the 1.9 of real estate, that gets you to about a $4 million value, which is still 10% lower than where the broker penciled their asking price. But there's a couple assumptions here that are really flawed. So let's give them credit for the multiple. That's fine. Even though that multiple is, I think, well above market for a company this earnings size, we'll just give them credit and say, cool, we'll give you credit for a 3.5 to 4 multiple. Okay. But to say that this business would do 600K of earnings, especially with the inconsistency that they have already provided us just with the numbers I showed you, doesn't make a lot of sense to me. And then when you really peel back the layers of the onion, and this is their P&L, it starts to fall apart even more. So I have this fundamental belief that you can only do so much with a business's P&L. Like the changes have to exist somewhere, right? So if we look at the revenue and just say, okay, for 2023 they did 6.2 million of revenue. Their COGS was 3.6, and so we have $2.5 million of gross margin left over to get to our 600K earnings number, right? Which, if you just run the math on that really simply, if we have 2.5 million of gross margin, then we need to have $1.9 million of operating expense to get to 600K of SDE or EBITDA or cash flow, right? Pretty basic. 2.5 minus 1.9 equals 600. But when I go through this P&L, and I'll spare you the exercise, you can pause this video and go through line by line if you want. But when I go through this P&L, there's not a lot on here that feels like there's $200,000 or $300,000 worth of cuts. So their total operating expenses were about 2.28 million, which left them with a 263K profit. Which I think is closer. And then when you add back in some other things, maybe that gets you to a 400 number, 450, which is what we gave them credit for. But I just don't see $350,000 of savings in this P&L. So just going really quickly, I don't think any of their e-commerce marketing fees can really be cut. Maybe payroll is an area where you could have some savings, but I mean, the total sales payroll here is, 400K. So to get 350K of savings, I don't think you're firing the entire sales team almost, and you probably don't want to fire any of them. Bank charges, maybe there's something there, but I wouldn't really count on savings being in that. Some of these other items are pretty small. Insurance, you're certainly not cutting that. Maintenance on the building, probably not cutting that. Owner's payroll is 50K here, so okay, we'll give them credit for 50K of an add back. And then office and warehouse payroll, again, this is another big item. Maybe there's some cutting that you can do there, but I wouldn't buy the business in the presumption that you're going to fire a bunch of the staff, especially when the total payroll is only $600,000. The rent probably can't change that meaningfully. And then we start to get into warehouse supplies, probably not changing that, telephone and internet, utilities, etc. And suddenly we've stacked up to $2.7 million of total operating expenses, or $2.27 million of total operating expenses. And the only area that I could even feasibly consider a cut would be, we'll give them credit for 50K, so that takes them from about 260 to 300, and then maybe they're saying there's some savings in some of these payroll items, but other than that, I don't see where it's possible structurally for this business to generate 600K of earnings, right? Just based on this, if you have $2.5 million of gross margin and this expense structure, where are those savings coming from? All those expenses seem super reasonable to me. Insurance, third-party fees, maintenance, those aren't things where you can just magically snap your fingers and they disappear out of the cost structure of the company. The only possible area that these savings could be generated from are payroll, right? And we see the owner's payroll is already broken out. And so to me, when I look at that, it just feels like a really massive leap to somehow say, hey, this business can magically get to 600K of earnings. And this is, if nothing else, I hope shows you how to think critically about a business's P&L and figure out, hey, is what they're telling me about the business's adjusted EBITDA or adjusted SDE a real number, and can it even really be achieved? And once you can start to see some of these P&Ls in 3 dimensions, you can start to realize in a lot of cases the ad backs just don't make any sense. And in this deal, to me, I don't think they make a lot of sense, which is why I think, honestly, even giving them credit for 400 or 450K of SDE here, which would be 200K worth of ad backs based on this P&L, feels like a stretch. And so to go back to the valuation of the business, it's, to me, even this valuation might be pretty ambitious. I'll show you one other thing, though. Assuming somehow we felt comfortable with that, here's how I would think about a deal structure. And I'll go through this quickly because we've already looked at a lot of different elements of this deal. But if we said the SDE is 475, which again I think is pretty generous given the P&L review we just did, give them a 2.5 multiple, which is essentially midpoint for a company of this size, gets us back to that kind of 1.1 number. The real estate's 1.9, so $3 million total deal value. I would think about a deal structure that would be 1.9 at close, a 700K seller note, and a 500K earnout. Here's a couple potential structures for an earnout. Could be 100K a year for 5 years with an EBITDA target. Could be 165K a year for 3 years, which is just that number divided by 3 with another EBITDA earnout target. And then the capital structure for that would be something like if we've got a $1.9 million loan, which would primarily be collateralized by the real estate, would be my presumption, and should be well supported by this asset base. We got a $1.9 million loan. We have a 700K seller note. We've got about 475K of earnings. If we assume a 20-year amortization on that loan because it's real estate collateral and not a typical operating loan, we'd have about 183K of free cash flow left over with this deal structure. So I think this would be, assuming those earning numbers are real, a way that I would think about financing this deal or structuring it. But I would have a lot of questions. And based on their margin structure and some other things, I don't think at all that a $4.4 million valuation is even remotely reasonable for a business of this size and with this cost structure. So that's my 2 cents on this industrial supply business. I'd love your thoughts about how to think about deals like this. And if you're looking at something like this, or if this was helpful for you as you look at and evaluate deals on your own.